Welcome back, everyone, to another Kingscrowd Podcast. I'm your host, Brian from Kingscrowd. I'm joined by Scott and Léa. A lot happening in the news. We take just a couple weeks off, not even, for a little break, and we have more topics than we can probably fit into one podcast segment. So we're going to be talking on a couple of topics today. One of the big things Scott and I will be covering first in the news segment is Rally Road, or Rally, the collectibles platform, fractional ownership. A lot of you have probably seen them. A lot of you have perhaps invested in some of their offerings. Announced recently, they're going to be pivoting and basically kind of moving away from the direct ownership model. Scott and I are going to break that down, what that means, echoing a lot of the trends we've been talking about, everything else related to that. Then stick around for the second part of this episode, where we are going to sit down with Senior Investment Associate Léa and break down a deal review for Oshi. So we will be getting into the offering and everything else about that deal. All right, Scott, let's jump into the first segment today. Rally. So I saw this email, probably a couple of weeks back, or not even now. I think it was early July. Rally basically came out. For those who aren't familiar, Rally was a direct ownership platform for collectibles. You could get trading cards, watches, sports cars, and basically you buy a number of shares. They would fractionalize these assets, offer them to investors. Investors could invest. I invested in a couple different things throughout, varying degrees of success, I will say. Honestly, I think I still have one or two things that I forgot about. I actually have no clue what's going to happen to that. Maybe we can talk about some of that, Scott, if you know. But basically, sent out an email and announced that they're going to be moving away from this direct ownership model, where as an investor, you can go to their platform, you can choose an asset or an asset class that you're interested in, and then you can choose to buy one share, 10, 100, however many shares you want. Moving away from that more towards a fund structure, I guess I would describe it. Now, Scott, you and I have been breaking down a lot of the different trends just recently, and I think this is even pretty interesting because collectibles, I'm trying to think when it first came on the scene, maybe late 20-teens, like 2018.
You're talking about collectibles.com?
There was collectibles.com. What was it? Was it Otis, right?
It was like Jason started that. Otis came up next. There's like two or three alts. Alts.xyz was only alts, did their own. They didn't fractionalize, but they were a vault, and then they started a fund. During National in 2020 and 2021 and 22, COVID, cards went through the roof. Guys like me got bored at home, started playing with our cards again. Then it kind of crashed, and now it's back in a big, big, big way. Collectibles themselves are back in a big, big, big way. We have minted in the US, I forget the exact number, but individuals or families that are worth more than $30 million is at an all-time high. It's at like up 30% since 2024. Previous years before that was like 14%. So like the correlation to our generation having access to capital and like wanting to invest and touch things that are historic is like a very hot trend that if you follow Darren Ravel, who was on our previous, Kingscrowd annual event, it's not going anywhere. It's getting bigger. So then you would ask, why is Rally shutting down? And I'm not going to break any news here, but I'll tell you that there's another couple platforms, some of which are much bigger, that are also having conversations to do the exact same thing that they're doing. We won't name names, but similar concepts, we'll say. Today is like the crowdfunding day of the world for Scott. I start off my morning at 8:30 talking to our guy Ken from Republic. I talked to Rob from Rally, just completely coincidental, had nothing to do with this podcast today. So I'm like totally ready to go here. It's funny. If all the money is there and all the collectibles are hot and interesting and cards are selling like crazy, why would this happen? And the truth of the matter is, and you have talked about this a bunch, not about cards, but about IPO stocks. A few weeks ago, there was a Mickey, this has nothing to do with why Rally did this, but this is a reason that this is sort of coming to a head. A Mickey Mantle card sold for, call it $3 million. A few years ago, it was on Rally at around $1.5 million, and a bunch of investors got in it. And to this date, to this point, no one has any concept as to when or how or if they're going to get their money from the acquisition of the Mantle card. And that sort of throws all of the fractional ownership into the wind. And the funny thing is, it's very easy to kind of brush this under the rug a little bit on IPOs because there are complexities. There are hold periods. There's all kinds of stuff on public markets. With a card, it went up for auction. I own 1.25% of the card. It's sold to some rich asshole. He got money. Where's my money? And it created this sort of riff effect. And the other part that's been taking place, I would say, over the last 5 years with the collector community is once you get in it, like really in it, you start to realize that the physical possession of it is like half the fun. Like just owning a fraction of something that's parked in a garage in nowhere land doesn't scratch the itch. And when you're not liquid, I'm not only not liquid, but it's like not only can I not get rid of the card, but I don't even have it. And it's become sort of one of the reasons like collectibles early on struggle with this. Like there's a disconnect. And then, the part that we've talked about a lot here is just the fractional crowdfunded market. It just doesn't have the kind of interest that it used to have because of a lack of liquidity, because of uncertainty, because one person, whether it's Rally or it's an individual investor or owner, owns a majority of the card and owns the right to sell the card. And you're just along for the ride. And if that guy decides, I got so much money, I'm holding on to the collection forever, then you're just stuck. And if that guy decides, you know what, I made some bad bets and I have to have a fire sale, well, then you're unstuck, but you're screwed. And so it just got to a point where attracting people to their site to invest became harder. Acquiring customers became harder because no longer were you trying to get people into cards and explain to the people the value of a card. That was easy. It's getting to explain to them all these little weird nuances and why it's better to not wholly own and possess the card because of they tried all the things like it's vaulted, it's secure, safety. All of that was basically just, covered to say somebody else is going to take possession. And the last part is just a matter of being able to have all kinds of things to invest in, the retail class just really having different options and ultimately Rally having lower volume, needing to increase their fees. It further pushes down the customers and the business just became unsustainable. What isn't talked about enough is how fucking cool what they did was and how valuable the portfolio that they accumulated is. So very similar, Brian, to what we saw in the early days of crowdfunding with the Republics and the Wefunders, where they would take a certain percentage of ownership of the amount that was made available. So just by the act of being the processing platform, they accumulated a pretty significant portion of equity in a lot of really interesting assets. Then they got in the business of storing them. Then they started raising money and investing in them. And what ended up happening, and just between me, you, and the people listening to this show, this is a precursor to what I think is going to happen for a lot of the platforms. The most valuable asset that they are in possession of is the equities that they hold. And the actual portal and the transaction volume isn't sufficient enough to be in business. So they turn around, they look at their asset index and they go, we've got a 20 million, whatever, I don't know the number. Let's say it's 50 million, 100 million, whatever it is, valued fund portfolio of collectible assets. The point of it being tradable, the point of it being growing in value, being a non-correlative to the markets, a great way for private exposure, all those things are true. So why not just list it? So they changed their name to Pika and they listed it. And now you can invest in the growth of the collectibles market and they can continue to take capital and increase the size and expansion of their portfolio. And you get exposure that way. And by the way, you can still go to National, buy a card and keep it yourself. And I think that to me, really is like in a lot of parts, it's indicative of what's going on in this market in general. And it goes into the whole, we've talked about before, the prediction markets, the SpaceX, all the different things that people can invest in now. They just aren't going to put $50, $100, $1,000 into something that they don't own, they don't hold, and they don't see, and they're not sure they're going to get out of it. And so I think the fastest way for any of these platforms to really become valuable is to make themselves public-private funds, just like we've talked about on many shows before. And that's what they did. And I think it's really smart. I'm excited for the next evolution of this because they've accumulated a great asset.
So many jumping off points. I mean, just first off, for anyone, if you are interested in getting a deeper dive and a little bit of a breakdown, The guys, Wyatt and the folks, the team over at Alt.co wrote up a really good deep dive article where they kind of went into business model, different things that they've done, kind of where they might be moving to. I thought it was a really good analysis. It brought up, a few interesting points and like a few things that you said, Scott, I just want to touch on. I've always pictured for my own portfolio, if you even call it a portfolio, collectibles is a bit of a different beast, right? These are not revenue generating assets. They're things that have some sentimental value. Part of it is the coolness factor, like you said, where having the thing is cool. I thought one of the unique things that alts did is like this $50 million, T-Rex fossil that recently sold at Sotheby's. There's no way that Brian can be a whole owner of a $50 million thing. There's no way the average Joe, can afford that. But it lets you be a part of that type of thing. Now, not that T-Rex, but on Rally, they had a Stegosaurus. They kind of IPO'd it. So they did it actually, I think, before it was even excavated. And I think it's still, to your point, it's kind of up in limbo, like whatever happened to that offering, because there's this page that's a little bit stale now and you don't really know, what came of that. But it's a cool thing where you can be a part of some of these things where to have a part ownership in a dinosaur or some other fossil, you're kind of like placing a bet on that thing, right? Now, for me personally, it's a bit of a bittersweet, I guess, change because in some sense, I just personally don't have a ton of interest in classic cars or watches or other things like that. But I might be interested in, things like sports cards or maybe it's NFTs or fossils. I don't know if maybe eventually they have kind of different verticals or like funds that you can invest in just to get exposure to like the assets you're interested in. But I think,
I would assume, right, that they would do thematic at some point. That'd just be my assumption.
You would just have, it makes sense. It's like different funds to give you different exposure so you can expose different views of the future, your future, if you think these assets are going to outperform. I do want to just kind of ask a question, might be, there's obviously not going to be a right answer to this, but collectibles, right? A lot of the value of collectibles is based on supply and demand. It's just, are there more people that want it than whatever it was last bought for, whatever the price might be that might bid it up? But some of that is also around like the value of the dollar, right? Like here's this card and we know the dollar tends to be depreciating over time as we're printing more and more dollars. And so, the price of the thing's going to go up. How do you think about this in terms of your portfolio, Scott, with collectibles? Like, are you thinking about these as investments? Are they more on the fun side for you? Is a bit of a hybrid for both? Or like for investors watching the show, if they're thinking about collectibles and like what this means for the market and next to their startup investments, like, how do you process all of that?
It's a great question. I mean, I'm a fan of sports cards, less so now. I like the old cards because I don't like all the stupid stuff that they do now with all the colors and, whatever. It's just not as fun for me. But I have this thesis. It's the same reason I'm doing the Creator Fund. I have this thesis that the more AI we go, the more, not just having more time, but like the more everything is digital, the more we're going to have an interest in different kinds of assets that we relate to. And so creator to me is the new Hollywood. It's what we watch. It's our entertainment. We know it. So to me, that is a safe bet and something that's, only going to go up. When I look at cards and collectibles, I think it's going to be a massive market that just continues to grow because we're so used to all this digital stuff. And I'm not even totally sure how public market trading is going to be at some point, given there's all these AI models that are effectively trained and running for everyone. It's at some point, it's almost the same thing. And so you start getting into this like appreciating fun cultural asset world where I want to hold these things. I want to hold this jersey of whatever. I want to see it. And I think, you brought up a point about the Stegosaurus and I'm going to use it here. And I think that if you're truly an investor, you're a person who like and when I invest, I don't mean some rich guy who just like says yes to check. I mean, like you really like look at it and try to find value and make deals, right? Okay. So that person, I think, will have some exposure to this through the fund that they start, but they're also going to be going to shows and looking for things and Sotheby's auctions and golden auctions, and they're looking for deals. And an example of this is that Jack Dorsey's first tweet was an NFT that sold for $2.9 million. Right now it's worth about $5. Okay. So demand is not there. I'm not even joking. It's legit, like on OpenSea, I think for like $5 or $10. Demand is not there. On the other hand, there's several Michael Jordan cards that recently have doubled. I just told you about the Mantle card that doubled. There's actually, speaking of rally, they just posted a picture of one of their collectibles that was 5 million when they first got into it, and now it's 10 million today. There's a scarcity. There's also an interest in developing the market. Another Michael Jordan example. There's so many of these Fleer 86 Jordan rookie cards, but there's actually two other cards that are kind of rookie-er. They're even earlier than the 86. And for whatever reason, they've never really retained value. Now there's so many people in the space who are trying to find value that they're creating a market. They're buying it up and creating a scarcity market for those offbeat Jordan cards. I tell you this because it reminds me of public and private markets, where a person comes in and they buy up a ton of shares and they drive a price up or down and people bet on it. That to me looks like a maturing market where systems will be built, and you're going to just start to see people who are our age and younger who relate to the assets in a way that your dad and my dad thought of Chrysler. Oh yeah, they'll think of like GM and Jack Welch and like all these things. That's what they related to. Our generation relates to LeBron James, and we think of things in cultural asset form. And to your point about the Stegosaurus, which I think is actually an interesting one, if you're really interested in having a piece of ownership of a dinosaur, I would tell you it's very similar to going to Maine and making a donation and being able to name a whale. And I don't mean that as a joke. I actually think that for people who really care about things like this and archaeology and all these things, you should absolutely go, get interested in it, do research, and find the people who are responsible for excavation and maintaining these things, these historical pieces, and get involved there, and you own a piece of it because you're the one who's responsible for its long-term, whatever. You don't know anything about what that sells for, who would sell it, who's the buyer. It's very hard to invest in things that are abstract like that. Versus if you go into the collectibles cards, James Dean's Porsche, or Paul Newman's Rolex Daytona, or whatever, name your card, or name your Elon Musk signed business card. All these things actually have a value, and there's a million people who would love to have it. So I think it's important as we explore this market to understand that, like, if you're just going in to be a fractional owner, you can do that still by just getting involved in those things and like going to find card companies and go buy a Jordan that's maybe a cheaper, not a PSA 10, get a PSA 1 and spend $200 and own it and have fun with it. But if you want to be an investor who makes money at this, the game is maturing. And in my opinion, we could point to Rally and others and say, oh, they failed. That's failed. I would say that they matured. They just changed shape. They're still in the business of collecting and selling and pricing collectibles. And now they're doing it in a way that is more attuned to the market than they were a month ago. And so to me, it's a success story, 100%.
One question perhaps in a lot of people's minds who are watching this, just coming from the online private markets, is there a parallel? Is there a story or a broader trend here that comes into not the collectibles, but the startups, the operating businesses? Yeah. With a lot of these investment crowdfunding platforms, we've already seen, right, some consolidation, pivots in business models where they're perhaps focusing on some of the more mature companies, where they're getting more into the private Reg D space, secondaries, looking at things like that. Where do you think, is this foreshadowing more changes to come in investment crowdfunding?
I don't think it's foreshadowing. I think it's written as plainly as Bushwood Country Club is on the wall behind me. At a ridiculous pace, JP Morgan, Apollo, BlackRock, all of them are tokenizing their offerings as we speak. I mentioned the person I was speaking to this morning and found out even more about the tokenization of private fund assets. When I did Hamilton Lane, the private infrastructure fund with Republic, the whole point of that was get exposure to something that's professionally managed at similar fees to what the institutions are offering, and use blockchain and tokenization to track it and return it. Takes all the pressure off of you. It is managed professionally. So there is actually, it's not great liquidity, but there is quarterly redemptions, 5%, etc. So I kind of think, you saw Robinhood launch their venture. We did talk about USVC. It's mostly a bullshit deal, but like it is just the beginning of all of these venture funds that are going to become public, private, or private, public, however you want to look at it, how you name it. I just feel like where startups are going, where these platforms are going, I don't think I'm breaking news when I tell you that Wefunder, Republic, Start Engine, Our Crowd, Yield Street, they make 60, 70, 80% of their revenue from private off-market listings. They make very little on transaction volume on their secondaries, and they make even less on their primary portal. It's a supply problem, but it's also a demand problem. The market is saying, I don't want to lock up money for 10 years unknown when I could put it over here, over here, over here. And as all these new funds are going live, there's the over here. You're just going to put your money in that. So if you're a platform and you're CEO founder and you're listening right now, I would be reaching out to the guys at Rally. And I've told you before, I think what Republic is doing with mirrors, while it's a different thing and we could argue about whether we like the forward contract model or not, where they're trying to go, which is to exchange things, I would be reaching out to these founder CEOs and saying, how are you turning the ship? Because you've got a bunch of assets. Some of them are worth something and some of them are not. Will they turn themselves into funds and list? It wouldn't surprise me if Nick over at Wefunder took a bunch of their orange funds that are all YC based and they're all by Series C to Series B and just said, hey, we're going to create our own YC Combinator Index and listed it on NASDAQ. That wouldn't surprise me in the least. What a smart, if he does that, I get credit. What a smart idea. And I just think the foreshadowing that you're talking about is the CF market doesn't go away. It still has to exist and people can list, but it becomes, I think, just not as, I think that the volatility and the lack of liquidity make it really hard to compete mainstream. It has nothing to do with the quality, it has nothing to do with anything other than illiquidity and lack of volatility. And so you get the gambler mentality, which we talked about. You get a gambler mentality in the markets, and every investor, rich guy, institutional, all the way down to the poorest retail, they want to be able to get their money out. They want to see it reconciled same day. And so this is what you're seeing. And what you're really seeing is funds, smart guys and girls who run these platforms thinking outside of the box and finding a way to take an asset that is in decline and give themselves a future.
Makes sense. And I'll just quickly tease, we actually just recently published the first half of the year 2026 investment crowdfunding report. We break down a lot of different stats on platforms. So H1 2026, right, compared to 2025, did see about a 30% pullback. Now, granted, there were 30% fewer offerings coming to market. However, still stronger than 2023, 2024, below the 2021, 2022 peak. So we're going to dive more into this. I think we'll take some time next week on next week's podcast, dive really into a lot of the takeaways. I think there were some interesting things, but going back to your talking points, right? Yes, I think there's been this volatility. We've been in this kind of middle ground where it hasn't really been taken off like a lot of people said it was going to. And why is that? And, we're seeing some pivots in the way that a lot of the platforms are focusing more on the privates rather than the public side. I think some of that comes down to the business models as well. And what drives the business models, success or failures, like you said, it's the liquidity, the supply, the demand. The other thing just as well, if you just look at the number of offerings, so like, never mind investment dollars and investors, right? You have a certain amount of money you might be investing, but there are just fewer issuers coming to this market right now. So from the 2023 peak, there were about more than 740 Reg CF launches. We're almost half that, like 388 as of the first half of 2026. It's been a steady downtrend. Now, that being said, average amounts raised have actually been going up. Medians have been going up in places. So it's not necessarily a negative story, but there's just fewer issuers coming here. And so, is that an AI story of people needing less capital? Is it going more to these private options? There's so much more capital in the private markets. Are founders and entrepreneurs and these issuers finding capital in other locations? So we're going to dive into this more in the next week. If you are interested in checking it out, you can head over to Kingscrowd. We sent this out to our newsletters subscribers, so make sure you sign up for our newsletter. Scott, before we sign off and get into the deal review with Léa, anything else you want to say just on Rally or the markets in general?
No, I mean, nothing crazy. I really think that the next few, I'd say years, because it's, usually takes longer than you think, but I feel like it actually will be quicker. I just think you're going to see a lot of these kind of trends. And I don't think if you really sit back and you focus, you take away, whatever your biases are with regard to crowdfunding and whatever, and you just look at the market and the options and the things that people are investing in right now, I just think it's really hard to ignore that for a person who's not a full-time investor like you are, who's more of a hobbyer, that them picking the best deals is very hard to do. And if there's going to be quality funds out there that are professionally managed, it's going to be the safer play. And that's a no-brainer, right? Everyone would have invested in that 10 and 20 years ago if they could have, but they couldn't. We paved the way for that to happen with crowdfunding. And now it's like available. And I just think you're going to start to see more of the institutional retail reach. And I think it's a great thing. And I think all these platforms they have a choice. They can duck their heads and say, we're going to stick to crowdfunding and we're going to turn our backs on this, or they can do what the guys at Rally did and say, hey, let's try something different. It doesn't mean they can't go back to crowdfunding and primary portals if they don't want to. They certainly can.
Yep. Awesome. Well, yeah, that's, every week we're trying to bring you the latest trends, the latest news. And you kind of say, thinking a few years out, we've been talking about a lot of these things a long time before they happened. Not Absolutely. To also call out a few things we talked about. So talking about IPOs, SpaceX, go ahead and take a look at the price today and then go back to Scott and my episode a couple weeks ago. Kind of warned everybody, right? I think it's trading a little bit below 120. Another IPO, I'll just mention quick in passing, Boxable has finally started trading. That was going public via SPAC. Most SPACs tend to trade at $10 per share. Surged 20% the first day to around 12 at its peak. Currently trading at $6 today. So a little bit of a correction there on day 3 or 4 of trading, whatever this is. But not saying, right, we're not trying to predict price movements and everything, but I think we're trying to bring information, data-driven decision-making to be able to help investors. If you're a capital raising founder, whatever your role is in this market or the online private markets or broader capital markets, we're going to be bringing news that's relevant to that. So feel free to tune in each week. But with that, Scott, I'll let you sign off. And next up, I'm going to be welcoming Léa back. Léa is going to be going over a deal review this week, which is Oshi, currently raising on Wefunder. Now, quick plug. Oshi is going to be one of the companies presenting at the Kingscrowd Demo Day next week. That's going to be on Wednesday, July 29th at 3 p.m. Eastern and noon Pacific. So if you want to see more from the founder pitching Oshi, feel free to join us then. But let's welcome Léa to the show. And Léa, why don't you give us a quick overview and demo? What is Oshi and what are they doing?
Hi, Brian. Yes, today we are talking about Oshi. So for those who never hear about Oshi, the stories of Oshi is basically the founder has been a vegan for, I want to say maybe 15 years now already. And the problem that he really encountered is that he wanted to kind of get back on that seafood product, high quality taste. But the only vegan seafood product he was finding actually were highly processed equivalent of seafoods, meaning crab patties equivalent of maybe like steaks, thing that you just don't consume every day if you're not vegan anyway. And he wanted to just get back that filet experience. So what he has been doing is that he raised a lot of capital around 2021, 2022, 2023, and was able to develop a technology that is actually reproducing the shape and size of the fillet. So what I mean by that is if you look at a fillet, you have very thin layers. So you have layers of meat and then layers of fat, and it's a pretty complex form. And really what it took for Oshi to be able to get its product is not only food scientists, but also mechanical engineers to be able to build the machine and the manufacturing facility. So they're positioning themselves today as kind of a different category than the regular highly processed seafood products. They position themselves as a whole cut seafood. And when I say that, of course, this is highly processed product, right? This is made out of mycelium, but the final product is not reproducing highly processed items. It's reproducing raw fillets. So the reason why we chose to talk about Oshi is because I think there's 3 very interesting points about this company. The first is that in terms of traction, it actually is already sold in 100 restaurants, 150 stores, and it has a new partnership that should bring it around 120 new retail doors in the next couple of months. So I think that when you see this type of product, you want to see traction before investing. Otherwise, you have no idea whether customers are going to be interested or not. And especially here, because this is a highly premium product. And that's why it's having a lot of success with restaurants, because customers are probably more willing to pay a lot of money for a vegan filet in a restaurant where they have the full experience, where it's already cooked, than in your house where the product may look a little bit small. I actually tasted it myself. I want to say it's maybe 70% close in terms of both taste and aspect. Now, in terms of the taste, is it really tasting like salmon, or is it that my brain is tricking me because it's seeing a salmon and it's thinking it's a salmon? Well, it doesn't really matter, but that was interesting, and I thought 70% was pretty good, especially if you're vegan. I think that it's been probably so many years that you didn't eat salmon that it's probably good enough for you. So that was the first point. The second point is it actually got a $3 million investment from a Brazilian strategic partner that is going to take the technology and getting the manufacturing machines and start manufacturing in Latin America to be able to sell it in Latin America. So there's kind of a path for growth that is already decided, already traced here for Oshi. And the last point is that, well, the revenue run rate of the company right now is probably going to get it to double more or less is 2025 revenue in 2026. So these are the type of things that we want to see in a company like that. Brian, when you look at the deal, what were the thought that came up to you, and any questions that you had?
Yeah. So I love this type of discussion because the first thing when you think about startup investing, small business investing, trying to think big investments, you think, traditionally tech startups, maybe it's, energy, biotech, whatever. This is food. It looks like at first, it's like, oh, I'm investing in potentially investing in this salmon making company. They're making a substitute. But when you look at the data as you laid it out and as they lay out on their campaign page, it's hard to disagree with a lot of the facts, right? The fact that they have all this traction, the fact that they have a lot of investments, they've attracted a lot of VC investment capital and everything else prior, that they're having some of this success. But it makes sense. And honestly, even in today's environment, everything is about AI. How are you using AI? And a lot of the businesses that are being talked about being disrupted are the ones where it's, I can go to my Claude, my OpenAI, whatever tool or LLM of your choosing, and say, create the software tool. This is not that. You can't just go to Claude and say, hey, help, come up with a new vegan compliant, salmon fillet. It's hard. And hard things have defensibility. They have moats. They have actual, a lot of investment and a lot of capital intensity and everything else that goes into it and expertise. And because of that, it's actually really interesting to me. I think that, when you take a look at just some of their revenue growth rates and everything else that they're projecting, that they've done, a lot of their strategy, it's pretty interesting. I will say one of the things that caught my eye, Léa, that maybe you could talk about is the valuation. Now, they received some VC investment in the past. Maybe you can tell investors just a little bit about the valuation, because to some, the current valuation might kind of look attractive, but then if you see what the past valuation was, is that a red flag? So why don't you tell us a little bit about what's going on there?
Yes, the latest valuation the company had in 2022 was actually a 50 million valuation cap.
50, right?
They raised about 5 million through convertible note, and now they're raising at 18 million. So it's, I think, and it's actually a price round. So this is going to be the actual valuation. So not a big loss, I want to say, for the investors in 2023, because if the shares only converted now, it's, they actually, 2023 investors actually invested on the valuation, final valuation of 18 million. But if you look at their run in 2022, they raised at 42.5 pre-money. So you kind of had that drop from 42.5 to 18. Why? Well, this is exactly in line with the boom and burst of the plant-based food market. So back in 2021 and 2022, the market was booming during the COVID era. People tried a lot of plant-based food, and this is really where thinking that this will be a growing category that will kind of stick. Unfortunately, what we've seen is a lot of customers actually move away from that category. Probably heard it in the news. There has been a lot of backlash because a lot of companies were kind of selling themselves as healthy, but they actually were very high in fat, saturated fat, highly processed food. And so even if they were vegan, it didn't really mean that they were healthy. So a lot of customers kind of turned themselves away from these companies. And I think that the valuation drop really reflects the fact that it was overvalued or valued based on hopes that the market will just grow and that the tide will kind of make all boats rise. And unfortunately, the tide went down, and a lot of companies just crashed. So it's actually impressive for me that Oshi is still here and that they are still getting investments. I think that it's because, as they say, they're really building kind of a different category. Now there's a risk. And I think the big risk is that the market is still shrinking. So yes, there is a possibility that the company could succeed because they are building that new category, because maybe a customer will be, in a retail store and will see the crab vegan patty, and then we see the Oshi vegan fillet, and they could buy both products because these are different products, different experiences. But it's still a shrinking market, and there's still a risk that maybe less and less customers are interested in actually trying new products, or maybe that just vegans don't really want these highly processed products. So Oshi is pretty healthy. I ate it myself. Look at the composition. It's made out of mushrooms mostly. So nothing bad here, but there's still, I think, a suspicious sentiment within customers that could make it a little bit harder for the company to grow.
No, it's really good to know. And it's good for investors to be kind of aware that, yes, it may be swimming upstream, no pun intended, a little bit, to be able to try and go against some of those broader macro trends on the vegan food market. Now, the question for investors, Léa, let's assume that they can be successful. What does a successful outcome look like as an investor? Like, did they talk about it all? What type of exits they're doing, or what that would look like for this type of company?
So for me, definitely, successful exit will mean a minimum valuation of about $300 million, because you need to account for future valuation. We can't exactly know what that's going to look like, but kind of thinking, all right, 10x of 18 is 180. I'm thinking maybe a 300. Right. With the dilution, you could get more or less 10x, something like that. Now, of course, if they have to raise a lot of money, that could be a much, much higher point. I think that the company co-sold earlier. They have a good technology, and if sales are not here, if they have trouble raising capital, unfortunately, a sale could definitely happen earlier. And this is the risk with this type of companies. You say something interesting, Brian. You say it's a food company. And indeed, it's a tech company that is actually selling a food product. The thing is, when you have a tech product, it's extremely expensive to build, but you can sell it at a premium price. Here you have a product that is also extremely expensive to produce, that is being sold at a premium price within its market, but it's still a food product. You cannot just sell it at a price that is too high. As a result, Oshi actually has negative gross margin, which means that as of today, for every product, every fish fillet that they make, they're actually losing money because they just cannot sell it at the price that it costs to make. They are hoping to be able to increase the production very quickly, and margins should come back to regular food product margins. But in the meantime, that means that not only they need to grow quickly, but they also need to keep raising capital just to be able to produce their fillets. So that's really, for me, one of the major risks that I've identified. And so if investors want to back this company, they need to be very confident that the product is actually going to not only grow, but quickly do it, because Oshi will not be able to sustain itself for too long in that kind of negative gross margin phase.
Great. Well, I think you've laid out a really balanced assessment of this, Léa, both some of the bullish case, some of the bearish case. If investors are watching and interested in learning more, sign up for Kingscrowd. You can get the analyst report that Léa wrote that goes more into detail on all of these different topics and segments. Before we part ways, Léa, any parting words or anything else you want to let investors know about Oshi?
I've been watching the vegan food market for a very long time. It is a product that is different. everybody claims that they have a different product, but that one, I tried it myself. I can tell you this is different. So I think what investors should do is just maybe order it, try it. And if you think that customers will buy that, then it makes sense. Actually, it's kind of a rule of thumb for any food product. I feel before investing, it's always good to try it. So bon appetit.
That's great advice. All right. Well, thank you, Léa, for another great review. And thank you, everyone, for tuning in to another Kingscrowd episode. We'll be back here next week. As I mentioned, we'll be diving into more of the H1 first half of the year 2026 investment crowdfunding market report. And I'm sure there'll be lots more news by then. All right. We'll see everyone back here next week.